The Federal Reserve's decision to liquidate assets is a complex process influenced by its role in managing the U.S. economy and ensuring financial stability. Here's a simplified overview of why, how, and what assets they have. Why the Federal Reserve may want to liquidate assets. 1. Monetary policy. The Federal Reserve conducts monetary policy by adjusting interest rates and controlling the money supply. Liquidating assets can be a tool to reduce the money supply and combat inflationary pressures. 2. Balance sheet management. Over time, the Fed accumulates various assets, such as U.S. Treasury securities and mortgage-backed securities (MBS), as part of its efforts to stabilize the financial system. Liquidating assets helps manage the size of its balance sheet. 3. Crisis response. In response to financial crises, the Fed may purchase assets to inject liquidity into the system. Liquidating these assets after the crisis is over helps normalize its balance sheet. How the Federal Reserve liquidates assets. 1. Open market operations. The primary tool for asset liquidation is open market operations. The Fed can sell Treasury securities or MBS in the open market to banks, investors, or the public. These sales remove cash from the financial system. 2. Asset maturity. The Fed can allow assets to mature naturally. When a Treasury bond or MBS matures, the Fed receives the principal amount, effectively removing money from circulation. What assets the Federal Reserve holds? 1. U.S. Treasury securities. The Fed holds a substantial amount of U.S. government debt. These securities are considered very safe and serve as a benchmark for interest rates. 2. Mortgage-backed securities (MBS). The Fed acquired MBS during the financial crisis to support the housing market. Liquidating MBS can reduce the Fed's exposure to housing markets. 3. Foreign currency reserves. In addition to domestic assets, the Fed holds foreign currency reserves as part of its foreign exchange operations. For other assets, the Fed may hold other assets, including loans to financial institutions, as part of its crisis response and monetary policy efforts. It's important to note that the Fed's decision to liquidate assets is made in consideration of economic conditions and its dual mandate to promote stable prices and maximum sustainable employment. The specific timing and strategy for asset liquidation are subject to careful analysis and transparency to ensure they align with its objectives and do not disrupt financial markets or the broader economy.